Today I would like to analyze JDE Peet's. It's one of the largest coffee companies in the world, and maybe you know some of their brands. You can see here Dow Egberts, Jacobs, and Kenko. And they also have the Peet's Coffee. It's a coffee chain. And here are some other brands that they own, Tassimo. So they have popular brands, and if we take a look at the stock price, we can see it's down 12% for this month. And for the 1 year, it's down 32%. And around 5 years, it's down 55%. So it's looking bad about the stock price. And we're going to take a look at the financials to find out if this company is actually undervalued right now. So the first thing we can recognize is a market cap of 8.14 billion euro. So this is when we take the stock price, multiplies with the shares outstanding. So it's not a small company anymore, but it still have enough room to grow. And we have a dividend of 4.22%, which we can see here. They didn't increase the last 3 years. So this is not looking great, but 4.22% is a big dividend, I would say. It's not bad. Now we're going to take a look at the financial foundation. The first thing we are looking for is revenue growth in the last 5 years. This is very important because we want to invest in a growing business and not a declining business. We can see here in 2019, it was close to 7 billion. Then we have a decrease around 4%. Then we have an increase around 5% in 2021. Then we have a strong increase around 16% in 2022. And then we have a slow increase around 0.49% in 2023. So overall, it's looking good. We have a revenue growth in the last 5 years, and it's a check here. The next thing we are looking for is free cash flow growth in the last 5 years. This is a very important number because the free cash flow can be used to pay the dividend, to pay the debt, or to buy back their own shares, or to invest in their own business. So it's very important that this grows over the 5 years. So we can see here in 2019, it was around 1.1 billion, which is a strong number, I would say. Then we have a decrease around 29%, which we don't like to see. I think probably related to COVID. And then we have a strong increase around 66% 2021. Then we have an increase again around 6% in 2022. And then we have a strong decline around 58% in 2023. So we don't like to see that. Something is happening there. And overall, it's a decline. Yeah, we have to say 2019, it was 1.1. So it's a decline and not a check here. Now we would like to see the free cash flow yield over 4%. This also tells us about the valuation of this company. So if it's under 4%, it could mean the company is overvalued. So what we're going to do now is we're going to take the free cash flow, 569, and then we're going to divide it with the market cap. And then we're going to get the free cash flow yield. So the number we get is actually looking quite good, 0.06990, which means around close to 7% actually. Yeah, this is a great number. It's over 4%, and it could mean the company is undervalued right now. And we even have to consider this number is less than the free cash flow was in 2022 and in 2021. So if they can make a recovery and come to the levels of 2021 and 2022, the free cash flow yield would be even higher. So it's looking really good about this actually, and it's a check here. Now we're going to take a look at the balance sheet. We would like to see the debt to free cash flow ratio under 5. So what does this mean? It means that the company can pay back the debt with the free cash flow in under 5 years. So this is a very important number, because if a company has too much debt and cannot pay the debt back, they risk to go bankrupt. So we don't like to see that. That's why we would like to see the debt to free cash flow ratio under 5. So what we're going to do now is we're going to take the short-term debt. We have it here, 527 million. So then we're going to add the long-term debt as well here, around 5.39 billion. And then we're going to divide it with the free cash flow. and we're gonna get the debt to free cash flow ratio. So let's see what we're gonna get. So the number we get is not looking great actually. It's over 10. So it means in over 10 years, they can pay back the debt with the free cash flow. It's not a great number. They have a lot of debt, and I think they cannot quickly pay it back. But we also have to consider in some years they had a better free cash flow. So if the free cash flow go up again, it's not looking so bad actually, but it's still not a check here. And now we're going to take a look at the cash on hand as well, because here we can see they have quite a lot of money on cash on hand. They have over 2 billion euro cash on hand, which is a great number actually. They can use this to invest in the business or to pay the dividend or to buy back the shares. That's quite good actually. So it makes this number not looking so bad, but we still have to consider they have quite a lot debt. So the next thing we're looking for is shares outstanding decrease. So what does it mean? It means the company buys back their own shares and then the shares outstanding decrease. So we can see here, it's not really showing much actually on this point. They didn't buy back shares in 2020. Now we're going to take a look somewhere else. Maybe we can find something. So I think where we're going to look is cash flow. And then we can see if they did buy back their own shares. Where's they going to show it? Yeah, here. So here we can see how much they paid for the dividend. This is 339 million for the dividends. And change in stock, yeah. You can see here, they actually did buy back shares in 2022. 2023, it doesn't show anything, so I'm not quite sure. But yeah, they did buy back shares. Overall, they did increase a lot of shares in 2020. So overall, I don't think the shares outstanding decreased in the last 5 years. So it's not a check here. I would like to give my conclusion about this company. So let's start with a positive. They have a strong brands that are worldwide known. They have a revenue growth in the last 5 years, which is also good. And they have a high dividend yield around 4.22%, which is also quite good. We have to say they didn't increase the dividend in the last 2 or 3 years, which is not really nice. And they have a free cash flow decline. This is also something we don't like to see. And I think it's one of the main reasons that the stock price decreased so much, because the free cash flow decreased. And they have a high amount of debt as well. So when the interest rate go up, the debt can become more expensive if they need to refinance the debt. So it's also one of the reasons the stock price decreased, in my opinion. And something negative as well, they have supermarket brands that can selling the coffee cheaper. So I would say this is also something we have to consider. They selling the premium brands in coffee. So I think the stock can make a comeback. They have a good brand portfolio and they have not bad financials, I would say. So if they can sell more coffees in the future, this stock can increase again. And it does have some potential. The dividend is also over 4%, which is quite good. So it has potential, but it also has risk with the debt and the declining free cash flow. So we have to consider that. And we have to research more if we really want to invest in this company. So if you like this video, like it and maybe subscribe. See you in the next video.